Hi, my name is Peter Harriman and I work as a certified business advisor with the Maine Small Business Development Center. The Maine Small Business Development Center is a free, confidential business advising services with locations throughout the state of Maine. Hopefully, you found some of our resource videos already on how to write a business plan. The videos we're going to do today are in 3 parts, and they're going to talk about one of the most common questions I get as a business advisor. And that question is, what business entity type should I be? Now, it's one of the most common questions, but it has one of the most complex answers because 1, there's no one right answer, and 2, the answer varies depending on the person, the industry, and or the time that we're talking about. An answer that might be right today might not be right tomorrow. So for instance, you might start out as one business entity and find that as you grow, you need to change to a different one. So the 2 most common reasons I see people choosing a business entity are taxes and liability. Right? So oftentimes they ask, what are my taxes going to look like if I choose this entity? And how much am I liable for if I choose this entity? Now in these videos, we're going to talk about 4 different entity types. There are different ones, but we're going to talk about the 4 basic ones, right? We're going to talk about, on one end, the sole proprietor or partnership. We're going to talk the limited liability company. We're going to talk about a corporation, and we're going to talk about an S Corp, which is slightly different. We are going to go through each of those entities, focusing primarily on those 2 reasons, taxes and liability. Our video is for informational purposes. So when you actually decide to make your choice on business entity, we suggest that you talk to a lawyer or an accountant to make sure it is the right decision. Remember, our videos are for informational purposes, but hopefully by the end of the videos, you can understand where you might think about heading. Now let's start with the sole proprietor and the partnership. The sole proprietor and partnership, they're the easiest type of business to get into. Right? Now typically they require registration in the town that they're located. Now the town typically will have their own application form, and it's either called a DBA form, a doing business as, or a business license. I've seen it either way depending on the town. The fee for this form is typically $10 to $40. Turnaround time is almost instant, and as far as registration of your business, that's all you need. Now if you're in an industry that does food or alcohol, there's other things you're going to need to start the business for licenses and requirements, but for registering the business, that's what we're talking about for a sole proprietor. Now, what does it mean liability-wise for a sole proprietor or a partnership? The liability side of a sole proprietor, and this is the real catch, it's real easy to get started, but the liability side, you're fully liable. Okay, so if you are a sole proprietor, what that means is that you are the business. There's no differentiation between you and the business. So if you get sued, you are getting sued. Your business is getting sued, you are getting sued. Right? So as easy as the sole proprietor is to start and get going, that is the one big downfall that a lot of people cite. They don't want to take that much risk, right? Because within you is a risk meter of how much risk that you're willing to take. And within your industry is a risk meter of how much risk there might be there. So using the food example, if I'm making baby food, that's a high risk industry. If I'm painting pictures of people, well, that's a low risk industry as far as industry is concerned. But me, myself, I might have my own risk meter. I might be laid back and willing to take all the risk, or maybe I'm someone who I have a lot of assets and I don't want to risk those assets, or I have a family or whatnot. So your risk meter and the industry risk meter, you have to look at both of them at the same time when you're deciding which one. And that's why when people are looking at the sole proprietor or a partnership, just a general partnership, they say, well, it's a little too risky. Is there any protection I could get a little bit above that? And that's when they turn to the limited liability company, the LLC. The LLC takes you and splits you in 2. There's a business you and a personal you. Right? The personal you is just like that sole proprietor, just like that Partnership we just talked about, right? It's your social security number, that's your business ID as a person, versus the LLC has that personal, and it now has this new business ID, right? And the business ID is a federal employer identification number, an FEIN. So that FEIN, that account, is now the business account. And what happens is if you get sued as an LLC, it's still you getting sued, but now the liability is just limited to that business account as long as you kept the account separate. If you mix the accounts and you use your personal and business one and the same, well, then your personal and business accounts are what's up for grabs. But if you separated the accounts and nothing criminal is happening, then when we're talking about limited liability, it means the limited liability of that business account that you had set up. So anything in that account, anything the business owns under that tax ID that you set up, well, that's up for grabs. Now, I do always suggest to people, look at business insurance, right? Always get 3 quotes, because business insurance is a lot cheaper than you might expect. So hopefully insurance is your first line of defense and the business entity type is your second line, right? You don't want to depend on the entity type as your insurance method. You want to actually look and try to get some insurance. Now, here's the crazy thing. The LLC, whether it's a single member or multi-member, has the same tax forms as a single or partnership, as the sole proprietor or the partnership. Now, why this is in the 1970s, the LLC concept was developed, but the IRS never created a separate form for the LLC, a separate tax form. So when we're talking tax differences for the LLC versus a sole proprietor or partnership, there are none, right? We're not talking a difference of taxes, we're talking the difference of the liability, right? The LLC has that separation of accounts, so it keeps that bucket separate, whereas a sole proprietor and partnership, you're fully liable, right? So if we're looking at the tax consequences, the LLC and the sole proprietor or partnership, their taxes are going to be the same. And if it's one member, you're going to have the Schedule C. If it's more than one member, you're going to have the partnership return, right? Now, this is the other neat thing about the LLC. These forms are just worksheets. They're all going to be transferred to your 1040, right? So ultimately, these forms are all going to go onto your 1040 in some way or manner, right? And we'll get to that in a second. It's different than the corporate forms that we're going to get to, because a corporate tax form is an actual separate form. But these forms are just worksheets that you're trying to get to how much taxes do I owe. So on the Schedule C or the 1065, basically, it's going to ask you, what did you have in sales, right? And let's say you had $80,000. Great. It's also going to ask you, what did you have for expenses, right? It might ask you for indirect expenses and direct expenses. The direct expenses, we call them costs of goods sold. So if I'm a baker and I'm baking a cake, the eggs and the batter that I'm making, that's a direct expense. Indirect or other expenses, overhead expenses are like lease. So if I have a lease for $1,000 a month, it doesn't matter how much I sell, it's still $1,000 a month. I could have a great month, a bad month, still $1,000, right? So all these expenses we kind of lump together. We're just going to say, okay, let's say we had $30,000 in expenses. From the sales, we take the expenses, and that'll leave us $50,000 left. This $50,000 is what is taxed. Okay, so a lot of people don't understand that. It's not your sales being taxed. You could make $1 million in sales. If you have a lot of expenses, that's really going to drive your taxable income down. But this is what we're looking at for tax. That's why at the end of the tax year, you might see a lot of businesses focus on driving their expenses up, so they might buy a lot of equipment or whatnot. It's because they want to drive that bottom line down if they feel like they're going to pay too much in taxes. So what are the taxes? Well, there's two different ways or two different taxes we're going to look at. One is the self-employment tax, right? And that is basically Social Security and Medicare. And that is a flat 15.3% rate. The second is income tax, which we're much more used to, right? Now, the income tax varies. It depends on how much you make. You make a lot, you pay a lot. You make a little, you pay a little. So the income tax is kind of a moving target. It's much different than the self-employment tax, because that self-employment tax is just a flat rate of 15.3. So that's pretty easy to understand. So the income tax, and in Maine we have state income tax, we have state and federal. We're going to say that's 10 to 15%, just to guess, right? Because what we want to do, we want to add these two together, the self-employment tax and the income tax. We're going to add that together to get 25 to 30% taxes, right? As someone who's self-employed, you should plan on 25 to 30% in taxes off of your profit. Remember, not your sales, but your profit. Now, if you're a Schedule C filer, you're just a one single member LLC, or you're a sole proprietor, then the Schedule C is the worksheet. It helps you get to this number, which you then put on your 1040. If you are a partnership and it's a 1065, well, then you're going to take this 50,000 and you're going to break that up into different K1s, depending on how many partners you have and what their ownership is. But the bottom taxes are going to be the same. You're still going to have self-employment tax, Social Security and Medicare, and income tax, state and federal, based on what percentage ownership you have. So as we can see, we've just gone through the limited liability company, how the separation of accounts works to help protect you from a liability standpoint. We also went through the sole proprietor and partnership as far as the liability, having full liability, and what they look like for taxes. The next video, we're going to get into the corporation taxes, and then we're going to tie this all together with the S Corp. So I suggest you watch all three, because it'll all make sense if you see all three together. Okay? Watch my next video.